Now, no one wants a financially unstable business. And of course, the one key ways to making a business perform the way it should is to have a very dedicated accounting department, or at least a person, a good bookkeeper, who follows a very strict guideline that we like to call the accounting cycle. And recently I had went to a training, you will. In this training, we were being taught the financials of that day, the income statement, balance sheet, statement of cash flows, very important financial statements for a business to understand and know. And of course, it's very good to let you know your financial position in your business. And this room had to have at least 30 people in it of different, business owners from all over the country, different, business types and different models. But a good chunk, maybe 15 of them, did not know that you're supposed to have income statements done on a regular basis, at least monthly, and it is an accounting period you're supposed to have. And the guy giving the speech, no one knew, and no one could say. And there's probably about 15 of them that didn't know it. And of course, the ones that did know still weren't even doing it properly themselves. And if you follow the accounting cycle we have here, this will allow you to get to that point where you can make your income statement, your balance sheet, your statement of cash flows, retained earnings, stakeholders, statements of equity and stuff. There's a lot of statements you can make from this, but you have to follow this, or else you won't be organized to form those ending statements when the accounting period comes to a close. And of course, we'll start off with we have identifying transactions. Everyone knows this. A business makes a deal, buys something, loans, pays rent. There's a lot of things that go on in a business that we consider transactions. You're supposed to identify those. That's your very first step. And then you make the journal entries, which we have here. Journal entries are very important to know. Your journal entries are the fundamental baseline for all accounting. If you don't have good journal entries, you won't have a good accounting cycle going on here. And of course, you make your journal entries, your debits, your credits. Most people know what that is. And of course, all the journal entries get to a big point that we like to call the ledger, the general ledger. It's the accumulation of all of the journal entries into one nice area. And of course, it's all organized by a thing we call the chart of accounts. And that's the third step. And your fourth step, you have the unadjusted trial balance. Now, this is a statement that you make really quickly, looking at where you're standing now, and that statement will give you your balances, your debits, your credits, and at the end of that statement, they should be equal. Everything in accounting should be equal. Your debits should equal your credits. And if you don't, then you got an issue. And most of the time, in most businesses, it's not perfect, and this will be on balance. That's why it's called the unadjusted one. So we have to get to a point where it's adjusted and it is balanced. And of course, you can't do that without going to your worksheet. Now we have to analyze our worksheet. The worksheet is kind of roughly all of your statements put together, almost in a proto state. And you look through it, you analyze it, you see where the certain entries from the journal weren't, properly accounted for. So you do that, and then of course you make your adjusting entries based off that worksheet. So you look at the worksheet, you see things that were maybe not posted right, you didn't move things right into accounts. You start making those different entries, and we call those adjusting entries because you're adjusting the unadjusted trial balance. So you make your adjusting entries, then you come to your adjusted trial balance. Now, after you make all the adjusting entries, hopefully at the end you should have a balanced trial balance. And this just the trial balance is extremely important because it allows you to do a very pivotal thing. And that pivotal thing is you get to make your statements, your financial statements, your income statement, your balance sheet, statement of retained earnings. Now, these are all extremely important for one to know. And of course, after you can make those, you have to do something that everyone has probably heard of. It's called close the books. And closing the books is pretty much putting your zeroing out your expense accounts, your revenue accounts, and if you do have your business structured that way, your dividend accounts. And that usually pertains to stock with payments in stock. So those three things usually get closed out. They should be closed out if you're doing it properly. And you can't get to that point, and you can't make your financial statements unless you follow this extreme. It's almost been perfected. There's a reason why it's taught in school this way. It's a reason why every accounting software utilizes it because it's the best, quickest way to get you to the very end and closing your books. It's extremely important. And almost every accounting department follows it. And if you're a small business, a large business, you can be Walmart, you can be a guy selling water bottles on the street. If you follow this properly, it'll streamline your business, which is extremely important. And of course, I'd like to thank you all for listening to what I had to say and hope you all have a good day.